This IPO market just doesn't know when to quit. I figured Wall Street's appetite for new deals would dry up after that Uber deal came public with a whimper, but the underwriters keep finding these small companies with turbocharged growth rates, and the market laps them up, makes them into not small companies once they get going. Just look at Chewy, CHWY for you home gamers, the one-stop online pet shop that was spun off by PetSmart today. The deal priced above the high end of the range at $22. Then the darn thing exploded higher, opening at 36, then climbing all the way to 41 and change before pulling back, and it will be closer to 35. Still, if you got in on the IPO, Chewy's giving you a magnificent 59% gain. All right, how the heck does that even happen? What made Chewy so attractive to investors? And more important, could the stock potentially have more room to run? I wouldn't chase the stock at these levels necessarily, but the company's doing a lot of things right, and it might be worth putting on your shopping list if you're willing to be patient and wait for a pullback, although I understand if you can't wait, because we've had these second and third days that have been pretty good for the hot ones. The reason's pretty simple. Chewy's got a great formula. Let me break it down for you. First, as we know, anyone who watches this show, the humanization of pets theory, something we've been talking about for years here on Real Money. Americans increasingly treat their companion animals like members of the family, which means we spend more and more and more on their food and health care. Hey, this is one of my favorite secular growth themes. You remember the dogs start in the basement, then they go to your room, and then you're in your bed. Next thing you know, they got your spot. But the pet-related retail market is a dinosaur. It's a highly fragmented industry that's maybe, let's say, 15 years behind the rest of retail in terms of technology. As of 2017, e-commerce only accounted for 14% of the pet food and pet supplies market. It was 4% in 2015. These numbers have been growing like crazy as the pet space catches up to the rest of retail. Chewy expects that online penetration will reach 25% by 2022. And you know what? I think actually may be a conservative forecast. Historically, people get their pet supplies from the grocery store or superstores or feed stores. For some reason, the internet didn't take this business by storm, at least not until now. Chewy has got it all figured out, though. They're like the Amazon of pets. Fitting. The CEO comes from Amazon. He was a big executive there with a broad selection of high-quality products at competitive prices. More importantly, Chewy makes the whole process convenient. 2/3 of their customers are signed up for an auto-ship subscription program. It's the easiest way to get pet food. The company now has 7 fulfillment centers spread across the United States, allowing them to offer cost-effective overnight shipping to 80% of America, with 2-day shipping for nearly the entire country. And the CEO told me today that sometimes they're priced through Amazon when it comes to delivery. However, the real differentiator for these guys is the customer service. People keep shopping at brick-and-mortar pet stores because they want to make sure that they're giving their cats and dogs the right food. And sometimes that means you need to actually talk to another human. So Chewy has almost 10,000 team members who are on call 24/7, 365 days a year. They're well-trained, incredibly friendly, and they can give you the kind of advice that you normally only be able to get from a high-quality pet store. I know they're the real deal because when I tweeted about Chewy yesterday, they sent me these paintings, okay? First, of NVIDIA, all right? I think a bad day because of Broadcom, you know what I mean? And then of Marley, who's the dumbest animal alive. And he ate our banisters. He ate our banisters. Imagine. And people responded with their own incredible stories. They've sent 40,000 of these out, okay? It sounds like every time a customer's dog dies, Chewy's sending flowers and expressing their condolences with a beautiful handwritten note. They don't make you pay for the food for that month. I don't even know what to say to that. It's genuinely heartwarming. And Chewy, guys, I just got the report back from NVIDIA. That lump on his leg is not cancerous. Made the day. This morning on Squawk on the Street, we got a chance to ask Sumit Singh, he's the CEO of Chewy, about his customer-centric vision. Take a look.
We have 90% re-ups. We have 2/3 of our revenue that comes from Autoship, our subscription program. And our customers love engaging with us.
Sumit's right. I mean, if you look at my Twitter feed, you just see these over and over and over again. Now, there was a negative story about a dog who ate a snake, and everyone was mad about that. But forget about that and focus on this, okay? That formula is clearly working. Chewy didn't even exist 10 years ago. Company was founded in 2011 as a way to sell dog food online to raise money for animal shelters. And we favor those, too, right? These guys are both from kill shelters, all right? Then Chewy's sales took off, and now they're the dominant online pet store. The growth has been stratospheric, with net sales rising from $26 million in 2012 to $3.5 billion last year. And 2/3 of those sales are from that subscription business that I told you they keep re-upping on. 90% of the people do renew. Now, once someone starts shopping on Chewy, they tend to stick with them. It's just fabulous retention. Now, we know digital beats brick and mortar, and Chewy has got digital figured out. Well, again, the CEO, Sumit, is from Amazon. He's got it figured out like Amazon. Now, that's how the company can deliver such excellent numbers, which is the main reason why Wall Street went crazy for the stock. In the first quarter, Chewy's revenue growth came in at 45%. And while that represents a bit of a deceleration from the 68% figure from last year, the company's up against the law of large numbers. While Chewy's not yet profitable, as they've been investing too much in growing the business, like Amazon, their margins keep rising, which is amazing. At this point, it's easy to see how they generate positive earnings. That said, free cash flow is in the negative territory for now. But other than that, the financials, I really like them. If Chewy were an own independent entity, I think I'd be willing to recommend the stock even up here, right now, right here, after today's mammoth run. Unfortunately, it's not independent, and that's the fly in the ointment. In 2017, Chewy was acquired by PetSmart, and they still have a controlling interest in the company. There are two problems with PetSmart. One, it's got a hideous balance sheet, and two, it's in the thrall of a private equity firm called BC Partners. Luckily, Chewy isn't on the hook for PetSmart's debts, but it's still a company that may not be in control of its own fate. While the convoluted ownership structure isn't a deal breaker for me, and I did bring it up this morning on Squawk on the Street, I never like it when there's a private equity firm lurking that could crush the stock simply by ringing the register on its gigantic position. So where do I come down on this one? I totally understand why investors are losing their minds over Chewy. I mean, who wouldn't? Do you know NVIDIA's 12 now? Jensen one gave it. He has an ID card to get into NVIDIA anytime he wants. I put it on his neck. It's a fantastic company, even if it's not perfect. But the stock has run so much today, I wish we could have gotten a bit of a pullback to a slightly more reasonable level. What is reasonable? What constitutes that? Okay, at its current price, Chewy has a market capitalization of nearly $14 billion. That means the stock is trading at 3.9 times last year's sales. We know Chewy grew at 45% clip in the first quarter, but let's be conservative and assume that this slows down to 35% for the full year. That seems reasonable. In that case, the stock's selling at 2.9 times this year's sales estimates. And you know what? I mean, that actually strikes me as pretty reasonable valuation, which means the underwriters really lowballed this deal. Look, it's Stitch Fix, the subscription-based online apparel play. It's got a substantially slower growth rate than Chewy, 29%, and it trades at 2 times sales. I think Chewy deserves to trade at a premium, but just not this much of a premium. And say if the stock would come down, say, to like 31, 30, it would be trading at around 2.5 times their back of the envelope sales estimate. And those are the levels where I think that you should buy the stock. Until then, though, maybe you keep your bat on the shoulder, be patient. Oh, and don't listen to anyone who tries to dismiss the company as a second company of Pets.com that was a failure during the old .com days. It is so much better than that. And that is just unfair. The bottom line, even after today's magnificent run, Chewy isn't all that expensive. Company's got a great growth story, and they have legions of loyal customers. Still, I hate the chase, which is why I think you should wait for Chewy to pull back, say, to $30 for you to pull the trigger. That said, I can understand why any satisfied Chewy customer might want to put some away right here, right now, because they love the company that much. I'm channeling in my own Bill Griffith here. And this, by the way, oh, man, is that heavy. Have we named this pet yet?
Yes, we're going to name that pet. Well, we were thinking Chewy, maybe.
This is Chewy, okay? May Chewy have a long life in that particular fishbowl with that ornament. Okay, let's speak to Mary Beth in Michigan. Mary Beth.
Yes, Jim. Hello.
Hello,
Thank
Mary
you for
Beth.
taking my call.
Of course.
My husband and I have watched you for years, and we are grateful for the information you share and all the wisdom you have about the stock market.
Thank you.
And I also want to give a shout-out to your superb staff. They are so great in making you feel comfortable.
Oh, yeah. I know. I mean, incredible.
My stock is PetQ. It was an IPO in 2017, and it was featured on one of your shows back in August or early September 2018.
Right.
I bought it for my 7-year-old grandson so that he'd have a stock he could understand what the company did. My concern is now it's having some ongoing security claims by many different law firms. So I'm wondering if it's still a hold or sell.
Well, you know what I'm going to do? I'm actually going to suggest, and I've looked at this company. I don't like the law for investigations, but that's not necessarily a reason to get rid of it. I think you swap out of that and you get into Chewy. That's how great I feel about this Chewy. And we're switching to Chewy. I told my wife we have to switch to Chewy because it isn't like anybody else has given us pictures of Marley and NVIDIA. I think Chewy is the real deal. Right? It's got a great formula, this Chewy. Even after today's run, the IPO isn't all that expensive. Sure, I'd like you to wait for the pullback and pull the trigger, but when you get a company with a soul, maybe you just go buy something. All right, much more Mad Money ahead. Medicare for All has quickly become one of the top policy issues for the 2020 presidential race in the Democratic Party. What does the CEO of Centene have to say about it? I've got the exclusive. Then I'll say it. WorldCom's earnings were downright depressing. I'm breaking down the numbers. And lawyer calls rapid fire tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.